Zambia Blog Talk Radio.
Do you want to promote your business on Zambia Blog Talk Radio? Yes, that's right. Live on Zambia Blog Talk Radio. To book your spot, just make a donation by picking from the following categories. To get started, just call or WhatsApp the number on the screen and you'll be good to go. Live on Zambia Blog Talk Radio every Saturday for 1 full month. And it will stay on the recorded shows.
Hello, everyone. Good morning, good evening, good afternoon, wherever you are listening to us from. And welcome to Zambia Blog Talk Radio. It's the first Saturday of March, and we do welcome you to the show and trust that you are okay from whichever part of the world that you are listening to us from. Let me say good afternoon to my co-host from the great city of Lusaka, Mr. Mashonga. Hello.
Good morning, Uncle Nathan. How are you doing?
I'm doing fine. How's Lusaka today?
Lusaka is good. The weather is seems like it's about to rain. Hopefully it does. Yeah, and it's always exciting to be part of the show. Yeah.
Excellent. All right. Like we always say, please, we are come live and do share this link with your friends, your family. We have a very interesting subject today. We're talking about creating wealth using cash value insurance policies. Let me say good morning to my friend here from the cold country. Hello, the Ukrainians. Good morning.
The Ukrainians. Good morning, Zambia.
How are you,
welcome
my friend?
to the show. Oh, we are okay. We complain about the weather in Canada. You'll be complaining every day. So we don't complain.
You don't complain.
No.
So you have to get used to it. All
That's
right.
right.
So what we've done is this is something that involves the community, okay? It doesn't matter whether you're Zambian or not Zambian. This involves you. And our guests this morning, for others of us who are in North America, are going to help us understand some of these other ways of making investment other than the traditional ways that we are used to, okay? Joining us from the great state of California is Ms. Pumulo Stumbeko. Good morning. She's an insurance broker. How are you? Thanks for joining us.
Good morning, sir. Thank you very much. Thanks for having me.
We do appreciate you waking up early in the morning. We know in Cali, it's probably the sun is just coming up on the mountainside, right?
Yes. You know, we are, we're lived in different time zones of the world, so we are just quick. We are soldiers.
Excellent. Also from a great state of California is Mr. Mwengo Siwiti, is also in the insurance business. Good morning, sir. Thank you for joining us.
Good morning. Good morning. I have an echo.
What is causing that, Chairman?
He has two. So just mute one and then open the other one. He has two. Yeah. Let's open. Actually, let's allow this one. Let's take away this one because I know.
Oh, okay. Yeah. Technology has got its challenges and it's. we shall get there. So those of you that are joining us, we did invite, like I mentioned, that some of our community leaders or association leaders, if you wish, to be part of this discussion. And we just wanted to encourage them to sort of, as we begin this discussion, to share and interact with us in a way that we begin to understand some of these things. So to you, Ms. Pumulo and Mr. Siwiti, my first question is, we always hear this terminology, broker. Please explain to us. Please explain to us what it entails to be a broker.
Okay, we unmuting.
We are muting.
Please unmute your mic, Bamwengu.
Okay, can you hear me?
Wonderful. So we'll take away one.
Okay, it is still there.
Okay.
Okay, that's good. Mr. Mwengu, my question was, we always hear this phrase, insure broker. There are brokers in different, what do you call it, industries and for different reasons. What does it entail to be a broker?
Yeah, basically in the insurance industry, there is terminologies that sometimes are mistaken. But in our case, when we are talking about a broker, you know, you have a broker and also you have an agent.
Yes.
When we're talking about a broker is that person who goes out there to different insurance carriers and looks for products that gonna meet the needs of the clients. So basically, he works for the clients. He doesn't work for like any insurance company. You know, he just finds, you know, products that will meet the client's needs. And so most of the brokers really, they are not captive, meaning that they don't belong to one insurance carrier. They can market products for different type of carriers. But when you're an agent, most of the time, you belong to an insurance carrier or a brokerage firm. You know, we belong to a brokerage firm in our case too, called Exeter's Financial Partners, but we are independent. We are not captive. So really, in a nutshell, a broker is a person who is facilitating the acquisition of insurance products on behalf of a client, which can be any person in this case.
So from what you have said, the impression that from the understanding of what you have said, then it means that in your situation, both you and Ms. Pumulo here, you are not restricted to a particular insurance company. Is that the understanding?
And Pumulo, you can take that.
Exactly. So what it actually means that we are a link between the clients and insurance carriers, because clients cannot go directly to insurance carriers. So we are a vehicle to make that connection, in simple words. So we connect you to the different needs that you have, because, you know, insurance has different purposes in one's life. Yes. So there are some companies who just who carry 3 products, and the people who are contracted with them are restricted. They are in a contract, so to say, only to sell their products. So this limits, for example, Mr. Nkama, if you have an agent who's helping you and is only contracted with one captive agent carrier, it means he is limiting you for what he can offer you, because he cannot go to, he's not contracted with other carriers to show you what else is out there. So basically, I would encourage all of us to have our personal financial information people to be brokers, because then we get the full picture of coverage. We get information and we have access to full coverage, which is out there in the industry.
Excellent. So in your situation, in our discussion, actually, my understanding is, as we spoke before the show, is that the reason I'm asking this question is important, because when somebody is looking at your caption on your name, it says you're in California. So for those of us who live in the States, the mindset, you know this, the two of you, the mindset is like, they are in California, so I'm in Atlanta, they can't help me. They are in California, I'm in Minnesota, they cannot help me. So explain the significance of the two of you being licensed in all 50 states.
Well, the significance is that we can we can be able to help every member or every Zambian, no matter what state you are. We are licensed in every state, and so it is a good thing for us. So you don't have to worry whether you are in Maine or whether you're in Atlanta. We are licensed everywhere, so you have access to us.
Excellent. That's a very important question, because I didn't want people listening from different states to dismiss the discussion and say, well, they cannot help me. So everybody listening, that's why it's important that I said we engage our community or association leaders so that they understand that you can get in touch with Mr. Siwiti or Ms. Tumbeko anytime. Whichever part of the country you are, they can help you with any insurance. Let's talk about the insurance products that you are able to deal with or to service. So what type of insurance products are we talking about here?
So in the insurance industry, right, about life insurance industry,
yes,
there are two types of insurance. There is term life insurance, term because it is periodical, it can be 15 years, 10 years, 20 years, 30 years. And also there's permanent life insurance. So what we're gonna do here is I'm gonna let Pumulo talk more about term life insurance and the different type of terms and also final expenses. And then later on, I'll be able to talk about the permanent life insurance, which talks about whole life and IUL. So Pumulo, you could go ahead and take over, please.
Okay, thank you so much. So I'm talking basically on term life, and the two common types of term life is group life insurance and also group life insurance. And this group life can be employer-based or community-based. So the main advantages of having a group life is that the premiums are low. There's no medical underwriting usually for the group life and the term life, the group and the employer. And then there is also a personal term. So Mr. Nkama, you can go and get your own term policy. So a term policy just simply means it's going to end. It's for a period.
Okay.
And a common term, for example, if it's employer-based, it will end when you leave the job or when you retire. For employer-based, so it ends at a loss of employment. You can leave a job for many reasons. So that goes with the job. And that's why we are here to educate people, because a lot of people, when you talk about insurance, they're like, oh, I'm covered by my job.
Yeah.
So the thing is, people are living longer and the retirement age is 65. So you find that I have a lot of clients who are 65, they don't have coverage because they relied on their employer-based coverage and it ended with the job. And then, as you know, insurance is based on age, health, and habits. So as you grow older, the premiums are higher. And as you get to over 50, you develop the complications, medical or something. So then you can be classified as a high risk in insurance terms, which translates to higher premiums. Okay. So this information so that, as you are thinking about it and making these decisions, you make an informed decision. And then when we come to community, that's another term kind of policy, which is a group life. And for this one, the way it is structured on age. So at 65, the coverage drops to half. And then most of these policies, actually, the face value for this policy is only 20,000, maximum 20 or 25. So if you're in a group policy in your community, you're going to be attracted because the premiums are low sometimes. So there's no personal individual underwriting. They do group underwriting and they base their premiums on the age of the members of that group as well as maybe the medical condition. If there's too many people with high blood pressure or other conditions, then the premium might be a little bit higher. If it's a young group, the premium will be lower. But the main disadvantage of this is that at 65, the premium cuts into half. And then at 70, it reduces to 10%. So this is one of the big issues we are having in our trying to educate our community to say they are looking at the cost. You know, to say, I am going to stay in my group life. But guess what? The group life, if you're an employee, you're going to retire. If it's community, it's going to reduce in half. And unfortunately, in our community, we had such a situation where we lost one of our members. Unfortunately, he was above 65. We had to do a GoFundMe to put him to rest. So GoFundMe is very humiliating to families. And that's why one of the reasons why me and Mr. Mwengu are reaching out from now forward to Zambian communities to say, hey, you don't have to have a GoFundMe. You can look at all these other products that can kill 5 birds with one stone, you know?
Yes.
Yes, so that's where we are. So
let me, sorry to cut you short, let me have you break down some things that you have said here. So if you're in a group term life with an employer, when you quit, you are fired, you are whatever happens, your job ends, do they make a payment at the end of your employment with your employers?
So actually, this is it's very like, you know, some like when I started training, I learned a lot of things that, you know what, employers are the biggest holders of policies in the country. So to be specific, some of the employers provide a whole life policy, but it's term in our eyes because when we leave, it ends. Sometimes they are required by law to send you a paper in the mail to convert it to become yours.
Okay.
But most of the people, they don't. So what happens in that situation? Like myself, I've worked like 3 or 4 employers and I've left.
Yes.
A lot of people, they get excited to say, I was just talking to one person this week, they were like, I have like $500,000 coverage by my job. I don't need anything. But the insurance companies have these whole life policies in our name. So when you leave, they can maintain those policies. So it's your loss. So if I leave, they maintain those policies as the owner.
Okay, that's interesting.
Yes.
The next point I want you to explain on this. So you can still have a policy with your employer and also have a personal arrangement.
Exactly. Right? Exactly. So some people have up to 5 different policies because each policy will cover a specific area in your life. For example, I see our young man there. Is it Mashonga?
Yes.
Yes, our young man there. I'm sure you have some babies at home, my grandchildren.
He's not married.
Okay.
Maybe yes.
I even get excited when I see people who are just starting in life because this information will set you up, you know?
Okay. Yeah. Yes.
So some of us, we are over the hill, you know, we have grandchildren and they get this information when we are like, oh my God, I wish I had this information when I was 20 years old.
Yes.
I would be a millionaire right now, sipping some margarita on Zanzibar Island somewhere. So I'm excited to meet you here because this information, take it seriously. So yeah, you are starting out in life. You meet with brokers, Tumbeko. I look at what are your plans. Ideally, this is what should be happening to everyone. When you start up in life, meet up with a financial person.
Okay.
It's like we are financial doctors. We have doctors for everything, you know? You are sick, you go to the hospital, they tell us you need to do this. But the gap is all of us people, we don't go to financial people and they give us a roadmap of success to say, how am I going to be retired at 55? How am I going to create streams of income so that I don't have to work outside Walmart at 70 years? So now we're talking about the different products. Mashonga here is young. So I'm like, okay, let me set you up. One, you are going to have a house. You need a mortgage protection. You are going to need to marry. You need a wedding. And then you are going to, I think the three main things is like a mortgage, a house to start with, and then a wedding to marry. And then those children, how are you going to provide for them? For college, all this planning. Don't start marriage. We are asking all your relatives in you even
I know, right?
Yes. Yeah.
Okay. Before we bring in Mr. Siwiti here, let's zero into on this term, of course, term which is periodical as it relates to our communities. You know, we are living in the diaspora and we are living in groups in particular regions, okay? For example, my good friend Bella, the Atlanta community, Miss Nasilele here in Indiana. So how do these community group life term work? How does it work? If they give you a call, how would that conversation go with President Nasilele?
Mr. Mwengo, I think you can take that one because you are the one who has been in charge with the group lives in the insurance in US.
Right. Yeah, so with group insurance, usually we use Hartford as our carrier. And basically what is required when we meet the community, we ask the community to provide us with a spreadsheet which has the names of people with their date of birth and gender. Okay. And then we send that spreadsheet to Hartford, and Hartford processes that for it's some sort of a survey. It's some sort of a survey to know how many people in this community are older and how many are young, so that they can come up with a premium for a certain face amount, like 15,000, 20,000, or 25,000. So once they make those illustrations, they send back to the community, and then the community has to decide on which they want to go, whether they're going to go for 15,000 or they're going to go for 20,000 or 25,000. So once the group agrees on how much they want to go, then whoever is the president is going to get the applications now from Hartford and send them to individual people to complete them. And then once they complete them, we send the whole bunch to Hartford. So what happens is that the association becomes the insured, right? The association collects the premiums from people from the community, and then the association makes a payment to Hartford as a premium. So the association is the insured, and the association members, they pay money, premiums to the association, and the association cuts a check and sends it to. So when somebody dies, whoever they put as a beneficiary in that application, where the money is going to go to.
Okay, that's interesting. Some of the things that arise in these group policies or community policies, you talked about a spreadsheet. So when the insurance company looks at that spreadsheet, doesn't some little details of the position of that person or the individuals on that list, doesn't that arise when you're talking about immigrants? I'm talking about the issue of immigration here, because that's a big one. You both know that. Some people don't want to get engaged. They'll be like, they will start asking for my status and all those things.
So for Hartford, as long as you have social security number, then you can apply. Now, there are some companies that you don't need to have a social security number. You just need to have an employer ID, which you can get it from IRS. And you can use that. And Pumulo can go on over that. She has been doing that mostly to help people who are not having legal status and be able to obtain life insurance. But if for Hartford, you have to have a social security number. And then that's why even for people that we're going to indicate as beneficiaries, they have to be people that have social security numbers. That's why we ask people that have families back home. If you don't have a family member here, you only have family members back home in Africa, we ask you to find a person here in America whom you have trust in, and you can use that person as a beneficiary. You know, we did this before. One of our members died, and we took the body back home, and we had selected one of the members of our community as a beneficiary, and you know, they had communication with their family back home, so we were able to get their family back home about $8,000 out of the 12,000. I mean, with the 20,000 that was used.
Okay. Before we take a break, I'll let Kasuluba ask his question because he wants to go back to something that we raised.
Yeah, actually, thank you. I'm back to Anpomulo. The point you raised is actually very cardinal, and it speaks, I think, to many young people, younger people, like you said. It is very important to actually plan for the future, which is a comment I think I saw from also and Mwanza, who wrote something like that. But then, first of all, I'd like you to run us through how a young person who's just starting life or just midway can take advantage of such opportunities. But then at the same time, how affordable is insurance? Because many people actually do have the desire, but then the issue is affordability or things like that. So yeah, those two.
Yes. So how a young person can prepare for financial success and then also affordability. So I'll start with the preparation. So preparation, I think it's a mindset. I think this is a big challenge that for me, coming from Africa, born and raised in Zambia, I want to take on to financial education is my passion, you know, to educate everyone. And I think like, you know, the people who are in midlife or retiring or young, it's never too late. But my strategic plan is to start from the young people in high school, because once you have your ducks in a row, or once everything is set when you are just graduating, then you are set for success, because you will not do things like, I'll give a personal example. I went to college, I graduated, no financial class, you know, you just do things without direction. So our plan for me personally is to help people, educate them. Like in your case, what you need a house, you know, you need to marry, all those things. All you have to know what you want in life, and you put a plan, long term, short term, medium term. In the next 5 years, what do you want? I want to buy a house. So you come to me, okay, now, then I'm going to tie this with affordability. So actually, it's the opposite way. When you are younger, insurance is more competitive for you. It's better to get it when you are younger because you get more value for your money. You are in good health. Your insurability rate is really high because the insurance, they look at your health and see to say, if this guy is taking out a policy for 1 million and he's 25 years old, you are likely going to live for the next 50 years versus me who's over 50 and I go to look for a policy for 1 million. They're like, what are the chances of this person even carrying the policy for 2 years? It even gets worse if I have medical conditions. So then they just cut down to what they can offer me. But a young person as yourself, the sky is the limit. You can walk in an insurance company and say you want a $1 million policy, and then the rest is details. They look at your income, how much discretionary income you have, and they actually tailor the program to your affordability. So
Okay.
everything is highly personalized.
Excellent. Before we continue our discussion here, let's take a commercial break, and then we shall probably also try to see if we can take some comments or any questions our community leaders are asking on the platform.
Do you want to promote your business on Zambia Broad Talk Radio? Yes, that's right. Live on Zambia Broad Talk Radio. To book your spot, just make a donation by picking from the following categories. To get started, just call or WhatsApp the number on the screen and you'll be good to go. Live on Zambia Broad Talk Radio every Saturday for 1 full month. And it will stay on the recorded shows.
Thank you for joining us. We're talking to Ms. Pumulo Stumbeko and Mr. Mwingu Suwiti out of California. They are both insurance brokers licensed across the 50 states of these United States. My colleague from the freezing Canada wants to come in. Roger, are you ready? And those of you that are online and joining us would like to hear from you what type of comments that you have, because what we want you to understand is that we are not just talking about policies or products here which cater for your funeral. Please understand that. Yes. No, because the problem to cater for Zambia. Here, Mr. Siwit and Ms. Tumbeko are trying to help us understand that our insurance policy is yengi. Maybe if I say it in the language, it will sink better. Because it is sunguri more. And that's one of the difficulties I have with Mr. Siwit being in America. When you are preaching, you know what I'm saying?
Right.
It's like, Chairman, come in here before I go off on a tangent.
Yes, okay. Just to tighten up a little bit, when you say group insurance, how many people make a group? That is number one. From the comments, you can see people saying when you leave your employment or you are over 50 in retirement. I'm not sure if you mentioned the solution to those who are above 50. What are the options? Even term life is coming to an end. What are the options in insurance, and how expensive or cheap can it be?
Okay, so I hear the question of the options. If you're actually term life in a group life, it reduces in half at 65. So if you had a 20,000 policy, you are only going to get 10,000, the beneficiary. And there's only one benefit, which is a death benefit, which goes to your beneficiary. And coming to talk about one of our myths and our beliefs and our culture, people don't want to talk of insurance to say, yeah, Nganafa, why should I pay money for people to enjoy when I'm dead? Vakansonkela, they'll bury me. So the thing is, we are here in diaspora. You know, we are not in Zambia. So me and Mr. Mwengu, we are trying to make this message loud and clear. If you're in diaspora, please, this thing of I don't have a status, they don't care. Insurance companies, all they need is a social security number or tax ID. They do not check your immigration status to say when did you come in or how you came. That number is for identification, to check that you are a criminal or not, to check the medical database, to see what kind of medical history you have, so they know how to classify you as an insurable risk, either high risk, low risk, or medium risk. So it has nothing to do with your immigration status. We just came from a training the manager there was actually telling us to say, you know what, we know this country is country built or with the work of immigrants. Immigrants
Yeah.
are the ones doing the work in this country. They need this protection. He actually said in his own words, I quote, we don't care how people came here. We just need an identification number to identify them so we can check their criminal and medical record. Now, coming to term options, I would say if you have a policy at your job, yes, that is a plus. Have an additional policy. If you're in a group life insurance, have an additional policy. And what you do is you take a policy which has got living benefits, is the key word. I want all of you from today to remember to say, I want a policy with living benefits. That's the key word. If someone comes to you to sell insurance, ask them if it has living benefits, that policy. Otherwise, if they don't offer living benefits, tell them you are interested to talk about a policy with living benefits. That's where you're going to find all these things that can help us set us up to create wealth and do all these lifestyle that we want to accomplish in our life.
What are living benefits?
Good
So
question.
living, yeah.
Yeah, so what I would like to add on there too is I think you asked that what is a group, right?
Yeah, how many people? How many?
Yeah, a group. If you submit the spreadsheet, when you submit the spreadsheet, 70% of that should be insured. That means if I submit 10 people, 70% of those 10 people should get the policy in order for them to accept your group. So it's 70% of the group submitted, right? So the living benefits, you know, today to buy long-term care by itself, it is very, very expensive. So what the insurance companies have done, they have added riders to the policy. You buy a policy and they attach it with a rider. And that rider can, for if you have a critical illness or chronic illness or terminal illness, they use the same policy by getting up to 93% of the face amount to be utilized for any type of medical expenses you're going to incur. No questions asked. As long as the doctor says you have a chronic illness or a terminal illness, so you go use the same policy and you get the money to be utilized for, like these days, we are having a lot of people that somebody has a terminal illness or is going to need a certain type of surgery. And we start asking people to raise money, to raise money, to raise money. We can create these things for you so that in case you have a terminal illness or a chronic illness, you don't have to be asking people to say, let's raise money, let's raise money. You can create that right away. And the company is going to give you the money to take care of this. So we need to change our way of thinking. Let us live as, you know, when you go to Rome, live like Romans live. When we come here to America, there is a certain lifestyle that we need to adapt in order for us to enjoy this life. And it's because of this that we are bringing this education so that people can be educated. We are tired of raising money when somebody's got a condition that needs an operation. No, we can create these things in our community.
That's true. That's very true. Let's take this question from Bella. He says, what is the rate of return on the living benefit? Do my beneficiaries continue to receive the living benefit after I pass away?
I think the question is a little bit we need to clarify something here, because when you say what is the rate of return on the living benefits, living benefits are chronic illness, terminal illness, or critical illness. So there's no rate of return on this. These are riders that they are attached to the policy. That's it. You buy a policy for 100,000, and they say with this 100,000 policy you've bought, We have also attached in it, in that premium that you're going to be paying, right? It's part of the premium that in case you get a critical illness diagnosed by the doctor or a terminal illness, we're going to go and get from that 100,000 policy up to 95 or 93% of that amount to be utilized for chemotherapy or any type of medical expenses.
Okay.
So when you're talking about the rate of return here, it's a little bit a question, the whole life, and I'm going to be explaining that later on.
Yes.
The whole life has a rate of return. Yes, on the money that you're putting in. And we say up to 4%, which is a gross rate, because you have to reduce the mortality rate and administrative fees. So it's 4% gross. But it's different.
Before we get into explaining the whole life thing, that's the other part remaining. Let's look at Ms. Nasilele's question. Is it possible for one to go back to the former employer to claim their benefits? I presume that's on a life policy.
So it's only possible if when you leave your job, you converted the policy to be your own. So employer policies, they are 80-20, meaning you pay 20%. The employer pays 80. So when you leave, you have to continue paying the 100%. And most people don't do that. So once you don't pay the premiums, then you cannot go back to that policy unless you change the policy to 100% owning it and paying 100% of the premiums. And before we move to the next one, I just wanted to talk about one of the riders, which is long-term care. Well, long-term care is actually a need that 70% of human beings need in their lifetime. So all of us, 70% of us are going to need long-term care in our lifetime. But then now I'm addressing to those specifically in the United States, and specifically if you are in a high earning income bracket. What this means is that if, for example, I unfortunately have some illness where I'm unable to perform 2 or more of my daily living activities.
Yes.
I cannot work. I need help. I need money to hire a caregiver to help me do my work. And I would just want to bring this out because we have a lot of immigrants in diaspora doing this caregiving job. So these people who have these policies with the long-term care rider, this is where they are getting their money from to pay these caregivers. So I, Pumulas Tumbeko, when that time comes, if I need a long-term care, I'm going to hire somebody to take care of me. It's not that these people are rich. No, it's a planning. They have this policy which is giving them 3,000 a month, 10,000 a month, 6,000 a month to pay for their care. And they turn around and pay a caregiver 2,000 a month, and the rest they pay for their medical bills, mortgages, and that. And why I'm sharing this information, because some of the Zambians are in a high income earning bracket, and they must look at this. And everything can be structured, personalized to your affordability and your medical situation. And why I really want to emphasize this, because the people who are in a high income earning bracket, they do not qualify for government assistance for this long-term care. So what happens? Mulos Tubeko needs long-term care. They look at my financial profile. Okay, she has $500,000 in a 401k. Guess what? This is one of the reasons people are going bankrupt. Because they have to pay long-term care out of their pocket. And it can cost as much as 140,000 annually. That being said, some of these conditions, they are not permanent. I can be in that situation for a month, for maybe 6 months or 1 year, then I recover. I go back to work. but I didn't have a long-term care policy. Guess what? I went to my 401k and cleaned it out. So by the time I retire, my 401k is empty. Long-term care and lack of planning is one of the main reasons people are going into bankruptcy. So it's very, very important for people who are in the high earning income bracket to take care of this.
Very quickly, before Mr. Siwiti talks about whole life here, on the group or community term policies, can you put a rider on it?
No,
You cannot.
no, you can't.
You can only put a rider on a personal policy.
Right.
Okay, okay. I just wanted to make that, to get that out of the way, because I think it's important. Mr. Siwiti, please go ahead now, explain the whole life package
Okay.
and how it is structured.
Thank you. Thank you. So, you know, when we talk about insurance, you know, a lot of people, especially people from third world countries, we have always known that the insurance is when somebody dies, that's when, you know, the people that remain benefit. But we are here to tell you that life insurance for centuries or for decades has been used to accumulate wealth. And you know, many people, when they talk about the investing, you know, we don't use the word investing in our case because we believe these are savings vehicles. You know, they are not investing, they are savings vehicles. So what I want people to understand is that in money, there are three buckets where money is concerned. There are three buckets. There is one bucket is called a taxable bucket.
Okay.
And this taxable bucket, you have stocks, you have mutual funds, you have money market. So that composed of a taxable bucket. Some people right now have their money in this taxable bucket. Then they also have another bucket called tax deferred bucket. Now, this tax deferred bucket, that's where you have your 401k and also you have your 403bs. So those are tax deferred, right? Then the last bucket is a tax-free bucket.
Okay.
You can call it tax-free or you can call tax advantage bucket. So our objective, right, is to look at ourselves and say, where do I want my money to be? Do I want my money to be in the taxable bucket, or do I want my money to be in the tax deferred bucket, or do I want my money to be in the tax-free bucket? It's a choice you have to make, but you have to make that choice with the knowledge of what is happening today. See, because what is happening today is that for every taxpayer, for every dollar that a taxpayer is paying today, right, 75 cents of that dollar goes to pay Social Security, Medicare, Medical, and also interest on the USA debt, right? And the rest of the money, you know, the rest of the money from the $1 is paid to Homeland Security, White House, and any other federal programs, right?
Yes.
But they are saying that now, $1 out of $1 a taxpayer pays is going to be 94 cents are going to Social Security, Medicare, and also on the debt, American USA debt. So we are only remaining now with about 6 cents to pay these other federal obligations. So what does that mean? What really means is that very soon, in the near future, taxes going to have to rise because the government has so many unfunded obligations. And because of having so many unfunded obligations, they're going to have to raise taxes somewhere, somehow. And what does that mean for you if you have your money in a taxable bucket? What does it mean to you if you have your money in a tax-deferred bucket? Right?
Yes.
So you have to be ready to understand that right now in America, we are in the lowest tax margins in American history. We are in the lowest. It may look high to you right now, but we are in the lowest because the tax margins have risen up to 94%. Think about it. Right now we are at 37, but the tax margins have risen up to 94% historically.
Wow.
Right? So can you imagine when the taxes rise up to 94%, which means you may have your money in 401k or 403b or maybe in stocks. That means you may be thinking you got 500,000, but because of the rise in taxes, that 500,000 may end up being maybe 200,000 or 300,000. So what does it mean for you for your retirement? What are you going to do? That's the question we have to answer. So today we are coming here to share with you that there's an alternative. So what we are sharing to people is that use whole life, right? There is in insurance business, there are two types of insurance. We spoke about the term which Pomolo explained. Now
Yes.
I'm explaining about permanent life. Permanent life because it goes up to 120 years. So now, what the rich and the elite have been using, they have been using this permanent life to accumulate wealth, right? So there are two types of forms of permanent life. There is what we call index universal life and also whole life. Their differences is in their design. The index universal life, it is also cash value insurance, but it entirely depends on the performance of what the market is doing, the S&P and any other type of index. Do you understand? So they accredit your account depending on the performance of the market. And they will give you a cap. There is a cap and also a floor.
Okay.
Do you understand? So that is index universal life. But the one that we are using is whole life with dividends, right? Whole life with dividends. That means that when you establish this policy, let's say you are paying $500 a month, and for $500 a month, maybe your first amount of that policy may be 400,000 or maybe 300,000, depending on your health, because you have to go through underwriting. Once we find out exactly how healthy you are, then we design this product. But what is going to happen is that they have established a methodology of comparing what you can gain if you put your money in the bank compared to this other alternative. We call it an alternative way of banking. When you open a whole life policy, it's almost like having a supercharged savings account, right? Because imagine you have your money put in the bank. When you put your money in the bank, you're actually losing your money because any annual rate of return they're giving you is taxable. Whereas if you put your money in a whole life policy, the money grows tax deferred. That means you don't pay taxes as it grows. Even at distribution, when you're going to get it, is also tax free. That's very powerful.
Yeah.
And so when you accumulate this money in that policy, the word to use here is leverage. So now that you have accumulated that money, let's say you have accumulated 100,000 in that policy. Now, once you have accumulated that money, you can now start using that money for any type of thing that you need. It's almost like creating your own line of credit, right? So if you wanna raise money to pay a down payment on a mortgage, we can design a product. We can design a whole life policy for you and show you how long it's gonna take, depending on how much money you wanna put aside. And then we can go and get that down payment ready for you, and you go and get that money and pay down for your for your house. Also, you can use the money to, to do anything that you want. And when you take the money out, there are no charges.
Okay.
That's a good thing.
It's not taxable.
I'm sorry?
It's not taxable. When you say charges, what do you mean?
Meaning, when you put your money in 401k, right?
Yes.
If you're not 59 and a half years old, when you go and take that money out, they charge you a 10% penalty.
Okay.
Right? Because you're not
Yes.
59. But in this instrument, you take the money out, there are no penalties. See, when you put your money in 401k, you go and get that money out before you are 59 and a half, they will charge you 10% penalty. And on top of that, depending on your tax bracket, you have to pay taxes. So you're talking about a big chunk of money that you're going to lose. Right? And for this vehicle, you use money, you use it as a leverage. So instead of really truly using that money, you use that money as a collateral to take policy loans. So you use that money that is accumulating and you take policy loans, and those policy loans that you take, you don't have to pay them back, right? But you can, if you pay them back, it's even better for you, but you don't have to pay them back. So you take those policy loans, and when you take the policy loans, let's say you have 100,000 and you take 20,000 out, right? That 100,000 that you have is growing at the rate of 4%, right? So you say, I have 100,000, let me go and get 20,000 out. You get 20,000 out. When you get 20,000 out, they are still giving you the rate of return on $100 on 100,000, on 80,000.
Okay. The best way, sorry to cut you short, everybody listening, Vamwanza, Mr. Siangonya, honestly, all the community leaders, it's better to post this. We have it on YouTube. You can repost it and share it so that people listen again. I know information can be this information, when you are listening for the first time, it can be overwhelming. Quick question. I'll throw this to Ms. Pumulo since she's taken a bit of rest as you were talking. This question keeps coming back as we end the show here. Please explain again. This is Dr. Munsanje. I'll just read the last part. Please explain again how people without papers can be life insured.
People without papers, right?
Yes.
So I don't know, like, for example, everyone in this country should have a social security number, and then this issue of status is a sensitive issue. So what we advise is you have our number there on the screen, call me. But on an overview, generally overview, I can say, Pumulos Tumbeko came in on just an example. Pumulos Tumbeko came in on a visitor visa. And as you know, some of us who came long time ago, you can get a social security number on a visa. So that is sufficient. So if you got your social security number on a visitor visa, it's just for ID. And then that's scenario number one. You came on a visitor visa, you have not changed your status, you are in between status, that's what they call it. But you have a number, you have a social security number, that is sufficient. The insurance companies are not an extension of the immigration department, no. They are there to make money and help families.
They don't care about your status, right?
Yes.
All they want is social security number.
You have been working, you have a job, you can afford the premiums, you pass medical underwriting, you are financially capable of paying your premiums, you are not a criminal, you are on the run, you are high risk because next you can take a $1 million policy. Next time they hear after a week, you are a bad risk. So they are not going to cover you if you have a criminal record or driving, reckless driving. I'm appointed 20 per driver license. I'm sorry, they will not cover you. You are a high risk.
Okay, I hope that's clear, Dr. Munsanja, and everybody else, not just Dr. Munsanja. I think that's a very critical point to explain and underscore, because this issue of people not being in status keeps coming up and up. What we shall
Yes.
do, Roger, the Kasuluga, and all the leaders that have been listening, greatly appreciate everybody's participation, is I think we need to arrange or organize, what do you call it? We need to
Workshops.
organize some sort of community seminar on this with Mr.
Yes.
Sweetie and Ms. Tumbeko. Greatly appreciate you being here today. And I know, like I was telling Vamwengo here, I said, all it took is for me to listen to that audio clip you posted in the leaders community, Vapumola.
Amen.
And I said to myself, this is very important. I think we need to talk about this. So people, it's not just about getting a life policy which pays for your funeral. There are plans there which you can benefit from in many ways or another. Thank you, Vamwengo. Thank you, Pomolo.
Thank you. Thank you.
Thank you, everybody, for listening. Join us next week at the same time. Coming up, let's look back again, is Open Forum.
Zambia Blog Talk Radio.